Hello, Tuesday World Economic News. We'll start in Australia, but not so much direct economy, but the Australian Government Bureau of Meteorology and December sea surface temperatures anomaly Australian region. Chart going back to 1900, and this particular sea temperature is minus degrees C up till about 1970-75 when it started going plus and getting increasingly hotter. Something's going on. Chart 2 is the Indian food crisis in one simple chart, and it is trends in per capita available food grains and per capita income. This is India, so it's a chart with two things on it: the amount of money per capita and the amount of food grains per capita. And basically the food grains is not going up, it's going across, and the amount of income is going up. It was funny, down in the comments below this chart was, I think, an American who said, well, I presume an American, it's on Business News, said, just because you get a lot more money, it doesn't mean that you eat more. Doesn't he know nothing about India? Anyway, it is, as another commenter said, a classic example of more money chasing the same amount of goods. Inflation, basically. Wall Street Journal, who highlights need for US-China cooperation and questions dollar. Beijing Chinese President Hu Jintao emphasized the need for cooperation with the US in areas from new energy to space ahead of his visit to Washington this week. But he called the present US dollar-denominated currency system a product of the past, and highlighted moves to turn the yuan into a global currency. Will it happen before the world goes away? We don't know. Financial Times, Wolfgang Munchau, who I'm having as my Eurozone expert du jour, an article entitled A German-Led Eurozone Rescue. And the blurb for it is, not too long ago the European Financial Stability Facility was greeted as shock and awe strategy to end the Eurozone bond crisis, writes the FT columnist Wolfgang Munchau. Today it is considered too small. Would a higher ceiling and wider remit constitute a solution to the crisis? The answer is that it depends on how it is done. A widening of the EFSF role to buy debt and guarantee bond issues would effectively amount to a German-led bailout. The alternative, a more modestly sized EFSF, preferred by Germany, would probably end later in a messy periphery default followed by a Eurozone banking crisis that would require recapitalization. What Wolfgang is saying, the Germans come in and bail everybody out, or the banks go down, and they'll all have to be bailed out. Choose your poison. So we'll push on with the Eurozone. The Telegraph, co-UK. EMU policies are pushing Southern Europe into systemic political crises. Greece, Portugal, Spain and Ireland will stay trapped in structural depression through this year and well into next, rotating from a liquidity crisis to a chronic political and social crisis that exposes the inability of the elected governments to counter 1930s job wastage. And a note here, unemployment is 28% in Andalusia and 30% in Cadiz. There is an awful possibility or probability that German Uber-growth will increase the pain for peripheral Europe before it offers a meaningful lifeline to Club Med through trade stimulus. The central assumption of EU policy is that a rising economic tide will ultimately lift all boats. It is a fatal self-deception. A rising tide in Germany is precisely what risks shattering weaker vessels. It's a variation on the normal tax theme of they're hoping that if Germany does so awfully jolly well, it'll drag everybody else up. But of course it doesn't. It just exaggerates the difference between Germany and especially the peripherals. The Telegraph, again, German coalition split on increasing EU's bailout fund, And on the website, I pulled it down far enough so the photograph of French President Nicolas Sarkozy and German Chancellor Angela Merkel is visible, because it's quite a nice little photo. Down at the bottom of this one, because that was on German coalition split on increasing EU's bailout fund, and the article starts with Angela Merkel's coalition partners telling her how not happy they are to increase bailout funds, etc., etc. But at the bottom we get Finance Minister Wolfgang Schäuble said Germany might accept a formula that boosts the fund, that's the EFSF fund, figure of 440 billion or 750 billion including IMF money. Under rules needed to anchor the fund's AAA rating, it cannot lend much above 250 billion. We have to think about making sure that the 750 billion euro is in fact available, and that is not an extension or expansion of the rescue fund, he said. And it's just a typical political playing with words. And the more they do this, the more the market just goes, yeah. The euro part of this fund is a pot of money like this. But for it to get a AAA rating, it had to be a pot of money this big and promising only to lend this much of it, so that there's this much margin for error. And what Schäuble's saying is he wants the fund now to be this big so they can lend this much. So obviously the fund's now got to be this much to be AAA with this much margin of error. And he calls that, oh, it's just the same, you know. It's not an expansion of the rescue fund, when of course it is. I'm sure lying isn't going to help. Telegraph Co. UK, Irish lenders besiege central bank for emergency loans. Irish banks are running out of collateral they can use to borrow from the European Central Bank, turning instead for emergency support from their own central bank on an unprecedented scale. Now this is quite interesting. I didn't even know that they were still doing this, the local central banks. I thought it was purely the European central banks that could do this. But there are two things that go on. You've got open market operations, is where you get a short-term loan, you put collateral into the central bank, they do fresh air money and lend it to you, and then when the deal is over it's swapped back. The collateral goes back out into the economy again, and the new fresh air money just disappears just like it reappeared. And it seems that the Irish Central Bank are doing quite a lot of this to collateral that has been refused by the European Central Bank, so it's being put to the Irish Central Bank. But will they get caught with it? We'll finish with the Financial Times and the same subject, because it is really the big subject of the moment. In the meantime, though, we'll leave you with this bit of commentary from the Bank of America AML analyst. The ECB now owns close to 20% of the outstanding bonds of Greece, Ireland and Portugal. So they have been buying them. The ECB said, no, we're not going to buy them. But they've now got 20% of them. Trichet, he's the boss man at the ECB's hawkish rhetoric on Thursday will, therefore, have been aimed, at least in part, at increasing pressure on politicians to shift the burden of dealing with the periphery away from monetary authorities. That's him, he's monetary, fiscal governments. Also, this number suggests that EU authorities may have to face the issue of burden sharing, that's tax, the haircut things, between the private and the public sector well before 2013, unless they want to end up with the majority of the exposure to the periphery. So if you get a haircut now, the central bank will be taking that haircut because they have got the bonds. And I believe that some of those, you get the, I'll leave it, it's too complicated. This in turn points to the fact that the main elephant in the room remains the post-2013 crisis resolution mechanism, rather than the tweaking of the EFSF. This EFSF is meant to keep things going until 2013, where they're planning to write on the bonds when they sell them after 2013. If they run into trouble, they'll be up for haircuts. So obviously the risk will have to be put on the coupon of that, and it'll be a lot higher because you're taking more risk. But 2013 is looking an awful long way away, because nothing in Europe is going easily at all, and they're looking at all ways of fudging it, but every single way is a fudge. There is no easy way out of this, because they've miscalculated, the risk. They thought the future was going to be rosy, and it's not. It's murky. Bye.